Across the hundreds of business owners that I've helped, I've found that S Corp owners tend to cost themselves a ton of money in the way that they pay themselves. It's how they factor their W-2 wages. And I just keep seeing this over and over and over. And I asked them, how did it become this way? And they just say, my CPA told me to do it. That usually means there's a lot of money being left on the table. Real meat on the bone still, let's call it. In fact, we find a lot of high-income business owners are overpaying by $25,000+ a year in taxes. And, the problem is most of their CPAs are just a bit flippant about this W-2 number. It just feels right, kind of a number. So in this video, I'm gonna just explain how to think about your W-2 in your S Corp, and also a fun case study that breaks down how you might be able to optimize it. Let's get started. Here's what typically happens. You start a business, your CPA says you should be an S Corp. Then that business becomes really profitable. Your CPA comes back and says, we need to make your W-2 a lot bigger. And you ask them the number and you're kind of shocked with how big it is. And you ask them, is that right? And they say, yeah, there's really no reason behind it. So you accept it. And really what's happening in the background here is the IRS says your W-2 needs to be reasonable since you're an S Corp. But reasonable is vague. So a lot of CPAs interpret that as take as much as possible, the most conservative, least amount of risk possible. Unfortunately, there's also times where CPAs will take that and say, let's go as low as we possibly can and be ultra aggressive. And all of this is about trying to save on payroll taxes. So I rarely ever see kind of a methodology or any sort of equation around how this came to be. I've seen businesses where the owner is acting as a CEO and they're paying themselves $500,000, $700,000 a year. We've also seen scenarios where they're paying themselves, their CEO, and they're paying themselves $50,000 to $70,000 a year. Then both of those are not right and not reasonable. And that's where the $25,000+ a year tax mistake kicks in. So let's get on the same page of kind of how S Corp W-2 versus distributions works. So I've got just an overly simplified diagram here of the way that profit flows to its owners. First and foremost, I got $1 million of allocatable profit. Again, it doesn't exactly work this way, but this is a great way to look at it to help better understand. So I have $1 million of allocatable profit. First and foremost, I need to meet the reasonable compensation test, and that's going to come by way of W-2. In this example, I've got $285,000 of W-2, and that W-2 is subject to payroll tax. So naturally, people are trying to reduce that number by way of lowering their W-2, therefore saving in payroll tax. The rest gets paid as a K-1 owner distribution. So it shows up on your personal tax return through your K-1. What's nice is I have no payroll tax, and if I am QBI eligible, I get a QBI deduction on those dollars. Now, hopefully you can already see there's a bit of a tension happening here. Your CPA, if they're trying to play conservative, is going to hold a higher W-2 wage. Therefore, I'm paying more in payroll tax. You're trying to have the lowest possible W-2, so you lower your payroll tax, and there's a tension that starts to kick in. Let's take a moment and just look at how does the IRS view this reasonable comp, vague kind of reasonable comp criteria. This is an IRS fact sheet that you can pull up right on their website, and it's very helpful. It breaks down a lot of the factors that they look at in determining what should be considered reasonable comp and what's not reasonable. There's 3 points here I really want to look at and dive in a bit. Point 1 is duties and responsibilities. What are you actually doing for the business? Time and effort devoted into the business. How much time are you actually spending? If you're working part-time, that's going to be different than if you're not working at all. Or what if you're entirely passive and someone else is 100% running the business? And then what are comparable businesses paying for similar services? So let me give you a case study of a client that we had. Their W-2 is too high. What was happening was they've hired a CEO. They are not working day-to-day in the business. What's happened is they are now working part-time in an HR function. They were being paid W-2 $120,000 a year. Part-time HR person, that would be a very overpaid role. So we brought this to the attention of their CPA and said, hey, they're working in HR, they're working part-time, reasonable comp in a comparable sense, $20-$30 an hour. And so what they settled on that the CPA felt really good about was $50,000 a year. Well, that That reduction from $120,000 to $50,000 saved that client over $17,000 a year. That was there this whole time, but no one ever looked. No one ever spent the time to look through the factors and consider what should that client actually be doing. So I want to go back to this allocation diagram. Again, there's a tension here that I want to press upon. Before I go into our case study, I gave you an example where lowering their W-2 helped them, but I'm going to show you a case study where on one end, lowering their W-2 helped, and on the other end, actually increasing their W-2 helped. See, sometimes the lowest possible W-2, even with all of its IRS risk and audit risk, doesn't even save you in taxes. It costs you in taxes. Before I go into that case study, I want to be very clear. There's a lot of nuance. This has been built just to educate you on the tension that's happening and that your situation is going to be different, and everyone needs a personalized scenario analysis built for them. So let's jump into it. I warned you, there's a lot going on here. I want to focus on three components: scenario A and its W-2, scenario B and its W-2, and scenario C and its W-2. So you can see scenario A, we've got $1 million of income, and we are W-2ing ourselves 50% of that, so $500,000. I've kind of heard CPAs use that methodology from time to time. We're going to do the 50-50 ratio. We'll 50% W-2 ourselves. Again, this person is a CEO, $500,000. That is probably too much, especially if the CEO across the street in the same type of business is making $250,000 a year. We would probably consider that to be unreasonable on the high end. Now, what's interesting is we've got a scenario over here on scenario C where they're being paid only $60,000 a year to be a CEO of a company. That's probably not going to make sense. Now, if you're part-time HR, like I gave you earlier, that might be considered reasonable. If you're full-time CEO, probably unreasonable. And the humor of that one is they have a lot of IRS audit risk, and they're not actually saving in taxes being that aggressive. Perfect scenario in this example is actually scenario B, roughly a $250,000 W-2 that we then eked up a little bit to optimize for QBI. And we can see at the bottom how that all plays out. Basically, in both the too high and too low scenarios, they took home about $675,000. But the optimized scenario, they took home about $700,000. That's really $25,000 a year that they could be saving if they just optimize themselves. And again, the humor is they took a bunch of risk and didn't even save themselves in taxes in scenario C. In scenario A, they just costing themselves a lot. So scenario B in this particular instance is optimized. All I want to press upon here is that we just can't be flippant with what your W-2 is. We start with what is considered reasonable, and that is determined by their CPA. There's a lot of great technology out there that can help with that. Their CPA signs off on it, and then we want to make sure we're optimized for QBI and payroll tax so that your net take home is the highest it possibly can. Now, you might be asking yourself, why are you even looking into this? Isn't that the CPA's job? And you're right, it is the CPA's job, but we love saving our clients money on taxes. And we found that honestly, just people aren't looking here. They're not having scenario analysis built for them. And I think our clients really appreciate that we're going into their business and not just staying at the personal level. And there's so many nuggets, so many things we can find if we just go into the business level. So number two is we are saving money out of the business. If we're trying to execute tax saving strategies such as 401k plan, profit share plan, a cash balance plan, those all rely on how the W-2 is calculated and how we're optimizing for QBI. So we actually can't do our job at the best possible level if we don't understand the W-2 and have that optimized. Number three is enterprise value. We have found that there's a lot of owners when they overpay themselves, actually hurting their profit. In sellers' language, they would say EBITDA, and your EBITDA times a multiple is your valuation. And if your EBITDA is artificially low because you overpay yourself, sell, your valuation could be low and you could actually cost yourself hundreds or millions of dollars. Now, people say there's no way that's possible, but we've seen a lot of clients where we've looked back at a business they sold and it was pretty evident they got hosed. It's not like the seller's gonna usually give you an add back for that. You have to recognize, I have been overpaying myself. There needs to be an add back to adjust for market comp. So that's a tremendously nuanced scenario, but enterprise value matters, and how you W-2 yourself is a part of that. The fourth thing is really, there are so many other tax strategies that we want to bring to light that come after we have figured out an optimized W-2. And an example of that in my next video will be on the SALT Parity Act. And that relies first and foremost on the W-2 being right. So I hope I've made it clear that on a regular basis, if you can get a scenario analysis built, you can find a lot of tax savings. And the good news is you can do this right now, and your CPA can go in and analyze, could they lower their W-2? Should they increase their W-2? And ideally, your advisor is a part of that process. So if you want to see another major tax strategy, check out my next video. That's going to be on some tax strategies that are hiding in plain sight. So I'll see you there.